I am Madan Singh, Assistant Professor of Management Department, Sant College of Higher Education. Today's topic is process costing and subject is cost accounting. Subject code is BBA-102, class BBA first year and semester second, unit third. Process costing. Costs are computed for each process over a period of time. That is, production for a process during a given period under process costing. A separate account for each process is opened and all expenditure pertaining to a process is charged to that process account. The cost of product of each stage is found out. The finished product of a preceding process becomes the raw material of the next process. This is the format of process account. In the debit side, we write to input, to materials, to direct labors, to direct expenses, to overheads, to abnormal effectiveness, if any. Similar in credit side, by normal loss or wastage, if any. By abnormal loss, wastage, if any. By process B, output transferred to B, process B account. In the process B account, in the debit side, to process A account means output received from process A, to materials, to direct labors, to direct expenses, to overheads of process B account. In the credit side, by normal loss or wastage, if any, by abnormal loss or wastage, if any, by finished stocks output. If it carries to the process C, then it will again become a new account will be created. But in this case, I have just only taken two process account here. We also make a profit and loss account, which there are some values which is not found place in process account. So in the debit side, we write to process A account, to process B account, to office and administrative expenses, to selling and distribution expenses, or to abnormal loss, if any. And in the credit side, by sales, process A, process B, by abnormal gain, if any, and after calculating, it may be a to net profit or by a net loss. Important terms. To find out the metal consumed, we add purchases in the opening stock and subtract closing stock. Normal loss. It is unavoidable wastage during process. How to calculate cost of normal output? That is, total cost subtract normal cost and divided by the input units minus normal waste units. Cost of abnormal loss. Abnormal waste units into cost of normal output. Abnormal gain. Actual production is more than the expected production. In this case, we say that there is abnormal gain in that process. Cost of abnormal gain. Abnormal wastage units into cost of normal output. This is a practical problem which you have to write in your notebook, and thereafter we will proceed to the next slide. Means it is solution slide. Now I am talking about practical problems. A product passes through three processes A, B and C. The details of expenses incurred on the three processes during the year 2019 were as follows. Process A, B and C. Input units, cost price per unit is rupees 100, 10,000. Materials of process A 10,000, B 15,000 and C 5,000. Labor expenditure for process A 30,000, process B 80,000 and process C 65,000. Direct expenses of process A 6,000, B 18,150, C 27,200. Selling price per unit of output 124 process A, 165 process B, for C this is 250, and additional information are as given. Office and administration expenses rupees 80,000 and selling and distribution expenses rupees 50,000 were not allocable to processes. Actual output of the three processes was A 9,300 units, B 5,400 units, C 2,100 units. 2/3 of the outputs of process A and 1/2 of the output of process B was passed on to the next process and the balance was sold. The entire amount of process C was sold. The normal loss of the three processes calculated on the input of every process was A 5%, B 15%, C 20%. The loss of process A was sold at the rate 2 per unit, that of B, and rupees 5 per unit and process C at rupees 10 per unit. Prepare the 3 process account and the profit and loss account. Solutions. Here you see that in the process A account debit side, unit brought in is 10,000 units and unit price is 100. Now it becomes 10 lakh rupees. To sundry metals is given 10,000, to labor 30,000, to direct expense is 6,000. And in the credit side, by normal loss, as we have given, there is a normal loss is 5%. It becomes 500. So, and the normal loss is recovered at the rate 2 per unit. So, 500 into 2 is 1000. Now, total we have given here that actual output of the 3 process are as for process A there is 9300. Now you say we have applied 10,000 units in process A and 500 has been in normal loss. Now we have only just output 9300. So where is 200? 200 is abnormal loss, and abnormal loss and transfer to process B and profit and loss account is transferred by calculating SHDCHE. It is given in working notes after this slide. Now how we have calculated the per unit cost of normal production under process A. Normal cost of normal output is divided by normal output. What is normal cost of normal output? Rupees 10,46,000 is subtracted minus 1,000 divided by 9,500, which is 110. Now we have multiplied 200 by 110 and 6,200 by 110 and again 3,100 into 110. What is this? Profit and loss account. This we have given that process B. We have given that from process A 2/3 of the output is transferred to B account and rest is sold. So we have taken 6,200 to process B account. Now in coming in process B account to process A, we have received 6,200 units and amount is 6,082,000. Sundry materials of process B 15,000, labor 80,000, direct expenses 18,150. Normal loss in this case is 15%. So 6,000 15% is 2,700. Here now we see that the normal loss is unit is here is 930, and by process C account we have given here we have total units available is 5400, in which we have given that half is transferred to process C account. So 2,700 is transferred to C account and 2,700 is sold out, and rate of process normal loss is 150 here, and 930 is multiplied by 150, that is 4,650. Process C 2,700 is multiplied by 150, that is 4,05,000, and similarly 2,700 multiplied by 150 is 4,05,000. In the when totaling to the debit and credit side, we said that there is unit of in credit side is 6,330 and debit side is 6,200, means there is abnormal gain of 130, which is multiplied by 130, and this will become here 19,500. Now coming to the process C account to process B, we have received 2,700 units, which is 4,05,000. To metals is 5,000. To direct labor 65,000. To direct expenses 27,200. And two overheads are 2,700 units, that is 5,02,200. By normal less, in this case we have given 20%. Those 2,700's 20% is 540, and recovery rate of this is 10 per unit. So 540 is multiplied by 10, that is 5,400. Abnormal loss is 60 because we have given that there is now output is 4,800, but we have given output is 2,100. So 2700 we have to sold out, and we have seen here that in this case normal loss is 540, that will become 5400. Abnormal loss 60 into multiply by 230, that is 13,800, and profit and loss account is means 2,100, 4 lakh 83,000 here. Now totaling both sides, there is 2700 units of both sides, and debit amount total of process is 5,02,200 and 5,02,200 of credit side. Now preparing profit and loss account. Process A, we are getting 3,100 units, that cost is 3,41,000, and we get from process B, that is 2,700, that is 4,05,000, and from process C 2,100, that is 4,83,000. Two office and administrative expenses given us 80,000, and two selling and distribution expenses 50,000. Overall abnormal loss in all the three processes is 34,800, and sales from process A is 3,72,000, process B 4,45,500, and from process C 5,25,000. Abnormal gas is 18,850. Now calculating, we have seen that unit is 7,900 for both sides, but after calculating credit side total, that is 13,93,800, and we have seen here that the abnormal loss is 34,800, and in this case we are getting a net loss of 32,450. This is working notes. Cost of production equal to 10,46,000 subtracting 1,000 divided by 10,000 minus 500 units is equal to 110, which is used in process A. Cost of abnormal loss is calculated as 110 into 10,000 minus 500 minus 6,200 minus 3,100 units is equal to rupees 22,000. For process B, cost of normal production rupees 7,95,150 minus rupees 4,650 divided by 5,270 units, which is now comes here rupees 150. Cost of abnormal loss is calculated as rupees 150 is multiplied by 930 minus 800, which becomes rupees 19,500. In the case of process C, cost of normal production is equal to rupees 5,02,200 minus rupees 5,400 divided by 2,160 units equal to rupees 230. Cost of abnormal loss is equal to rupees 230 into 2,160 minus 2,100 units becomes rupees 22,000. Thank you, Madan Singh.